Welcome to StockInvest.us. Today, we are diving into one of the oldest debates in the world of investing: gold versus stocks. Both have their merits, but which one truly stands out as the better investment? If you're curious about long-term wealth building, you are in the right place. Let's start with a quick overview. Gold is a physical asset that has been used as a store of value for centuries, especially during economic downturns. On the other hand, stocks represent ownership in companies and are known for their high growth potential. The key difference between the two is simple. Gold preserves wealth, while stocks build it. As we explore this topic further, we will see how each performs in different economic conditions and which might suit your financial goals better. Next, let's talk numbers. Historically, gold offers a long-term annual return of about 1 to 2% after inflation. It shines during uncertain economic times, like recessions or inflation spikes. For instance, during the 2008 financial crisis, gold surged over 30%. In contrast, the stock market has a much higher long-term annual return, ranging from 7 to 10%, including dividends. Stocks thrive during periods of economic growth and bull markets. The Standard & Poor's 500, for example, gained over 1,200% in the last 30 years. So, if growth is your goal, stocks are the clear winner. But if you are looking for stability, gold might be a better option. This brings us to the question: how do these investments fare during inflation and recessions? Gold is renowned as an inflation hedge, historically rising when inflation is high. A great example is the 1970s, when gold skyrocketed over 300% during an inflation crisis. It is the go-to asset when economic uncertainty looms. Stocks, on the other hand, can face short-term challenges during inflation, but often outperform in the long run. Certain sectors, like energy and consumer staples, tend to do well in such times, offering investors some protection. During recessions, gold serves as a safe haven asset. Investors flock to it when markets are volatile, providing a sense of security. In the 2008 crash, while stocks plummeted, gold soared, demonstrating its crisis protection capabilities. Stocks may suffer during recessions, often experiencing significant drops. However, they have a remarkable ability to rebound strongly. After the 2008 crash, the stock market bounced back, gaining over 400% in the following decade. So, while gold is better in recessions, stocks recover and outperform in the long term. This brings us to the pros and cons of each investment. Let's compare them to see which fits your financial strategy. Gold offers a hedge against inflation and market crashes. It is a tangible, secure asset with low volatility compared to stocks. However, it does not provide dividends or passive income, and its long-term returns are generally lower. Stocks, in contrast, offer higher long-term returns, typically between 7 and 10% annually. They provide dividends, which can be a source of passive income. They are also easier to buy, sell, and diversify, but they come with higher volatility. So, if growth and income are your priorities, stocks are the way to go. But if you value stability and crisis protection, gold is the better choice. Now let us discuss how you can invest in both to maximize your portfolio. The best strategy for most investors is diversification. Experts recommend allocating 5 to 10% of your portfolio to gold for stability and crisis protection. This leaves 90 to 95% for stocks, which are geared towards growth and income. To invest in gold, you have several options. You can buy physical gold like coins and bars, invest in gold exchange-traded funds such as GLD or IAU, or consider gold mining stocks like Barrick Gold and Newmont Corporation. For stocks, consider buying index funds like Standard & Poor's 500 or NASDAQ exchange-traded funds for broad market exposure. You can also invest in blue-chip dividend stocks for consistent income, or explore growth stocks and exchange-traded funds for long-term gains. In conclusion, a balanced portfolio that includes both stocks and gold offers the best of both worlds: growth and stability. This approach can help you navigate different economic conditions and achieve your financial goals. Now, we would love to hear from you. Which do you prefer, gold or stocks? Share your thoughts in the comments below. Your experiences and insights can help others make informed investment decisions. If you enjoyed this video, do not forget to like it to support our channel. Your engagement helps us bring more expert insights and valuable content to you and our community of investors.